Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax efficient or tax free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no cost, no obligation consultation with me. Enjoy.
Good evening, everyone. It's nearly 6:30, and we're going to get the webinar started. We've got quite a few of you joining us tonight. So hello again. I know many of you saw me yesterday at my Tuesday 10 a.m. Webinar, but it's been a little while since we've done a special webinar. It's been since March, believe it or not. So I'm making it up to you because I have 2 in June and 2 in July. So we're kicking it off with tonight's special webinar this evening. And tonight we're going to be talking about using annuities for funding in retirement. So this webinar tonight came about from one of our weekly webinars. During our weekly webinars, if you don't know, I go over some updates on market returns, and I run through some snippets of analyst reports and what I think is topical or germane to what's going on today, and give you my thoughts and ideas of what the experts are saying out there. And then I do a section for financial planning. And I did one section, and usually that's a discussion for about 20 minutes to a half an hour, sometimes a little longer. And I got a lot of feedback that folks would like to learn more about using annuities in financial planning, because annuities, I know, are very confusing. When I first learned about them, when I started in the business in 2001, I was at a company called Payne Weber. I shared this with you on Tuesday, but I was talking to one of my fellow trainees, and he was a big proponent and fan of annuities, particularly fixed annuities. And we're going to talk about the differences between the different types of annuities this evening. But he spent a lot of time with me, and I still had a hard time understanding what the heck these things were and how they work. So, and then, it just really took years for me to understand. So I get it that they can be confusing, and it's important to know why you have them, how they work, and all of that. So it's 6:31. We've got quite a few people joining us. So I'm going to start tonight with a poll. I set this poll up a little differently. So we're going to see if this works. I want to get a feel for what your concerns are, because we use whatever funding source we use: stocks, bonds, cash, annuities, structured products. Structured products can be popular as well. There's something, I was featured in the Wall Street Journal. It probably goes back about 8 or 9 years ago now, discussing structured CVs, and they were a really good principal protection type of instrument, I believed at the time. They're a little more challenging today, but still have their place for some folks. But oh geez, what was my point in that? Oh, I don't recall. But there's got to be a reason for everything that you're using. Why take the risk of stocks if you don't need it in your portfolio? Most people don't want to just earn as much as they possibly can. They have a reason for having those things in there. So what is the reason? Why do you hear about annuities from some folks that they're necessary and good, and from some folks that say they're evil, run away as fast as you can? And I've lived on both sides of that argument. So we're going to discuss some of the pros and cons, and again, try to give you a general education of how they work and why they can be beneficial to your financial plan. And it's different for everybody. And you're going to see I'm going to mention this a couple of times because it's important. You're going to see some examples, and they're definitely not going to apply to you. This is an example. So everybody's situation is different. As is customary, at the end of this webinar, you're going to have the ability to schedule time with me if you would like a consultation. If you're already a client, well, you know that you can schedule time with me anytime. So feel free to do that. Or if you already have a financial planning meeting scheduled, let's keep that appointment, because we're working hard for preparation of that meeting. But if you're not a client yet and you'd like to schedule time and you haven't already had a consultation with me, feel free to use that calendar. Now I'll tell you the time is a little bit limited. We have I kept some time available for you folks tomorrow purposefully. We're having a bit of a technical issue with having that time populate, but Emily got it fixed for me. So Emily, if you're on this webinar now, I appreciate it. So we have time from 3:30 to 7 o'clock for you tomorrow. And then we have several days, the 23rd, 24th, and 25th of June. And then of course, going into July. So if you schedule time, that's your opportunity to ask questions that pertain to you. There's no requirement, there's no cost, there's no requirement for us to continue it. It's just good. I appreciate you folks being on these webinars. It helps me. I believe I become better at what I do by teaching things like this. I felt the same way when I used to practice and teach martial arts. It's the same way as expertise and keeping me on top of things with these webinars, and it certainly helps grow our firm, and people will appreciate it. So a little bit of housekeeping. You are on mute. You are being recorded. Yes, this recording will be available at some point. Chat is disabled, but there is a Q&A section at the bottom of your Zoom screen. So feel free to use that Q&A while we're going. I'll check in periodically and answer questions when it's appropriate. And if we can't answer all the questions, we'll go until about, it's 6:30. We'll go until, plan is about 8. Sometimes I can go over. I'll try to keep it an hour and a half because it's pretty long. And we might finish early, who knows? And some of you who have been on these calls might be chuckling right now. From an office point of view, remember, we are out most of the week next week at a training event down in Austin, Texas. So Wednesday, Thursday, Friday, we'll be out next week. Our summer office hours did start, so we close at 3 o'clock on Fridays. And we will be returning in the office beginning in July. So the first week of July, we're excited about that. I'm not sure how long we're going to be there because we have renovations planned, but we'll be there for a short period of time and then hopefully be back permanently very soon. So this is the first of 4 of these special webinars that I have immediately coming up. I should get back on the schedule of having one once a month after July. But tonight, of course, is funding using annuities and retirement planning and Roth conversions. The 30th of June is fiduciary assistance for power of attorneys, trustees, and executors. This is a course that I've taught to the bar associations for continuing legal education. So if you know somebody who is a power of attorney, a trustee, or executor, this is a really good, the June 30th will be a really great webinar for you to attend. The third one is investment fundamentals. What are stocks, bonds, cash, structured products? How do they all work? The reality, the next one, July 28th, is the reality of the 4% rule. 4% rule is a rule that's out there. It's talked about a lot. You know, it pops up in my Google feed all the time about, how much money can we withdraw during retirement, and that 4% rule always picks up. So I'm going to talk about the pros and cons of that, just like everything. So I want to go, let me just start, see if we have any questions first before I begin. No questions, good. So the first thing I want to do is launch this poll, and let's hope it works, because what I'd like you to do is rank your importance of risk. Now, there's 4 general types of risk we usually talk about. These encompass most things. I'm sure somebody could find some other kind of risk that's important, but most people, these 4 risk categories cover, and that is market risk, of course, the concern that your investments are going to drop in value. Longevity risk, the concern that you're going to outlive your money. Tax rate risk, you hear me talk about that a lot, the concern that taxes will significantly increase in the future. And long-term care risk, so the risk, the concern that you or your spouse, someone in your life will need long-term care at some point in the future. So there are those 4 basic risks. And what I'd like to know from you is, how do you rank them? What's most important? So I did this poll a little bit differently. I tried to go in earlier today and practice it, but I honestly just couldn't figure it out. So we're gonna try it with you folks, and we're gonna see how it works. Let me launch this poll, and I'm gonna ask you to rank how you feel about each one of these risks. So we do have a question. Andrew asks, can you set up closed caption on your end? I don't know. I've never I've never been asked that, Andrew, and I don't think, I'm looking at my, no, I'm looking at my options. I don't see an option. But listen, if somebody knows how to do it, I am happy to do that if somebody wants to send me instructions. Sorry about that. Are people hearing me okay? Raise your hand if you can hear me okay. Okay, very good. Thank you. All right. My apologies if you're having a hard time hearing me, Andrew. Okay, so let me go ahead and launch this poll. Now let's hope this turns out okay. Okay, so before you start, there are 4 different questions, and they all say the same thing, except for they say rate your number 1 risk concern in retirement, multiple choice, market risk, longevity risk, tax rate risk, or long-term care risk. Number 2 is rate your number 2 risk. So if market risk, as an example, was your number 1, you would choose that. Then the second question, if longevity risk was number 2, you would choose that one. Rate your number 3 risk in retirement. Longevity risk, let's just, or tax rate risk, let's say that was number 3, you would choose that. And then number 4, rate your number 4 risk. Okay, it seems to be working. I think you guys are getting it. Okay. All right. So I think is it raise your hand if you think this is working. It is hard not to get feedback from folks, right? But okay. So thank you for all those who raise your hands. Okay. All right, so I'm just watching your results. I got to tell you, it's really interesting. This is all over the place, and this really just brings home the fact that it's so important to have individualized plans and individualized strategies, because when I tell you that, I don't know if you folks can see this, but number 1 risk, for example, is almost split equally, 24%, 24%, 29%, 24%. So, I have my own feelings about what my number 1 risk is. I know what most people say, but these are really heavily weighted evenly, if that makes sense. So, that is really telling. So what that's telling me, folks, is that, like I said, it's very important that each one of you has your own strategy, because number 4, I'll tell you, number 4, long-term care risk is the most heavily weighted for number 4. That's 41% of you said long-term care risk is your 4th, right? So, but for many people, and this might be an age issue, for many people, that's right at the top of the category. So I'll also tell you that most people I talk to, you can stop answering at this point. I'll just end the polling. Tax rate risk barely is 29% compared to 24% is the number 1 concern for you folks. I'll tell you that, but that's barely. Most of the time I hear from people, what's your number 1 concern? Outliving my money, right? Longevity risk. Doesn't matter if you have $1 million, $10 million, $15 million. People say, I shared with you, I've never sat across the table from a billionaire. I hope that happens soon, maybe by the end of the year, it would be great. But I've never ever had a person who has said, I'm completely comfortable with funding my retirement. That typically is the number 1 concern. So I'm surprised to see it, but maybe maybe it's just that we've done a good job educating you about tax rate risk, and I'm really happy about that. And that's why tax rate risk came up high, because not enough people talk about it. Longevity risk is number 2. That's what I was just talking about. And then longevity and tax rate was tied for 3. Really interesting. And long-term care risk came in heavy at number 4. Market risk wasn't strong. It's interesting to me, considering the volatile market we're in right now. But again, you folks are, I guess, really comfortable with it. So that's great. So I hope that was helpful. It certainly was to me, and it's a good way to get this started. So let's talk about the topic of the night, which is annuities. Kathy says, comment, a year ago, my answers would have been quite different. Very, very good to hear, Kathy. So a year ago, Kathy, we started financial planning with Kathy. So I'm really glad to hear you say that. Andrew said, should have asked about Social Security reduction risk. Well, Social Security reduction, I would say, and that's a great segue to start talking about annuities, because Social Security is a what? It's an annuity. So really, if loosely, a definition of an annuity is really a lifetime income or and periodic income or periodic income from a source, usually with some level of guarantee. So it's from an outside source, not your own, right? You could basically say, I'm annuitizing my savings account. But usually when we're talking about annuities, it's some kind of outside source that you are offsetting risk to be able to give you some type of guaranteed payment over a number of years or a lifetime, however that is. That is kind of the strict definition of an annuity. And Social Security is an annuity. Pensions are annuities. That's this strict kind of definition. So Andrew, that's good. But the reduction of Social Security is definitely a concern. And that really has to do with the longevity risk, doesn't it? Because if you reduce your Social Security, or if your Social Security is reduced or eliminated, or they have to increase taxes to fund it, maybe we don't have enough. We know that the Social Security Trust Fund is set to go to zero in by 20. Oh goodness, 20. It's not 2020. I think it's 2031. I should know this off the top of my head, but it's been a while since I looked at it. 2034. Thank you, Andrew. 2034. You guys are great. Yes. So the Social Security Trust Fund goes to zero in 2034. The Medicare, maybe Andrew, you can tell me this because this was updated in October, but the Medicare Trust Fund goes to zero in 2020. I want to say 2029, but it's 2024 actually. I think it was reduced to 2024. Andrew, check that. You say 2026, and that could be. And I'm embarrassed. I typically know these off the top of my head, and you can just tell I haven't watched them or looked at them for a while. But 2026 is close enough, for crying out loud. It's 5 years. So yeah, so these are big problems, and I can get on a whole tangent about that. But let's talk about the topic of the night, and that is annuities. So strictly speaking, annuities are some kind of guaranteed payment from some outside source. You offload the risk. That other entity, Bristol Myers did this. Bristol Myers Squibb did this. Maybe 2 years ago now, they sold their pension plan to an annuity company called Athene, and they gave their participants the opportunity to roll over their pension into an IRA, or I guess take a distribution if they wanted to, but to do something with those funds, or to continue it to that annuity company. So instead of Bristol Myers being on the hook to fund the lifetime income for those employees, now it's an annuity company. So that's a strict definition. Generally speaking, annuities are an investment that's offered by an insurance company. And there are many different types. They kind of fall in 4 different categories, and that's a fixed annuity that kind of operates like a CD. So for a period of time, whether it's 3 years or 5 years or 7 years or 10 years, a period of time, they pay you a certain amount of interest. Now, typically, annuities have a defining characteristic, and I should have put this on a poll, and maybe Andrew knows the answer. But does anyone know? Raise your hand if you know the first company to use annuities, and they actually helped write the legislation that allows annuities to be tax deferred. I don't see any hands, but that company was TIAA-CREF, and I think you've all heard of them. Oh, Andrew confirmed me. I am right. Thank you, Andrew. It is 2024. Boy, I feel much better now. That Medicare is scheduled to run out of funds. The trust fund goes to zero. Yeah, so that was just updated in October after COVID. That was so in the every year. I'm getting off topic here, but that's okay. I'm going to finish this thought. Every year, the Social Security and Medicare Trustees report comes out at about April. And when they released it in 2020 in April, the Medicare was scheduled to be withdrawn to zero in 2026. Then they re-released in October, and it went to 2024. Now, just a few years ago, it was 2029. So the escalation, the acceleration is not great. So we need to keep an eye on that. So TIA first really gave wrote the legislation for annuities, and annuities have a specific characteristic in that they are, first of all, tax deferred, whether they're in any growth is tax deferred, whether they are in an IRA or a non-IRA. And we're going to talk a little bit later about those buckets. I'm going to bring them back to you just so we know where you should have an annuity and where you shouldn't, in my opinion. Now, that's the growth of the annuity. I once was coaching a financial advisor who had been in the business for some time. And we were talking about the buckets and we were talking about annuities. And I was explaining to him how annuities work. And he said to me, "Oh, I thought they just magically became all tax deferred funds when you put it into an annuity." And I said, "Well, listen, here's a good rule of thumb. Now, if you attended these webinars in the past, you know I generally don't like rules of thumb, but here's a good one. Nothing magically happens in financial world." So I know that was a little tongue in cheek for him, or a little smart ass, but I just wanted him to know that you have to really dig into the details and understand these things. If you're and he was an annuity user. If you're placing clients in platforms that are confusing on the face of themselves generally, but then when you get into the individual contracts, you have to understand them. And it can't ever be just set aside. You know, I've been using these platforms for many, many years, and I have great success stories and some struggles along the way as well. But what we know for sure is that we consistently have to go back and research the workings of these contracts when they're issued, because they're ever changing. And annuities that were issued last month are different than the ones that issued this month often. So you can't ever assume to know it all, but you better know the districts or the basics. Okay, let me clear these. Questions. Sorry, stand by. They're just in my eyesight, so I just want to clear. And let me make sure. Okay, so I'm going to go to my whiteboard. And when I do that, you know, I'm going to be looking down at the whiteboard so I can see what I'm drawing. So don't take it as though I'm checking my text messages or something like that. But we're going to dig into what annuities are, so you don't believe, like this other advisor at the time, that anything magically happens with these things, and get a general idea of how they work and the pros and cons, and where they should live in your plan, if at all. Okay, trying not to destroy things on my desk here. So let me bring up my whiteboard here before I do that. Okay, so raise your hand for me if you see my whiteboard, and it should say funding using annuities and retirement planning, and Roth conversions. Very good. Thank you, everyone. All right, so I'm going to bring this back up. Remember this: market risk, longevity risk, tax rate risk, and long-term care risk. Again, those being the general risks that we're trying to cover in our portfolio management and financial planning. We want to see which one of these are covered by using annuities. So we're gonna come back to this section. So let's talk about the different types. We first talked about fixed annuities. I'm going to try to write better for you folks. So what are fixed annuities? This is the easiest one. So a fixed annuity is very much like a CD. So it's CD-like. So you have $100,000, let's just say, you put in, and listen, this is, I don't even know what fixed index or fixed annuity rates are right now. I'm assuming they're about 2.5–3%. They are very much like CDs. And they pay an interest rate. So let's just say you get a 2.5% interest on $100,000, and to have that, you have to keep that in there for 5 years. So it sounds familiar, doesn't it? Yes, it's very much like a CD. The difference is, can you withdraw the money before 5 years? Well, with a CD, can you withdraw money prior to the maturity, right? This has a maturity, a CD. Annuities have surrender. Get familiar with this word. If you're going to consider an annuity or have one, this surrender period is important. And the surrender is typically the term, which is 5 years in a fixed annuity. That simply means if you cash that out prior to the 5 years, you'll have to pay a surrender penalty. Now, in the case of fixed annuities, it's a forfeiture typically of the interest. So there are all kinds of nuances. So, I might get a question or a comment that says, well, Mark, I have a fixed annuity with ABC company, and I can take the money out at any time and there's no penalty. That could be. That absolutely could be. But generally, there is some kind of holdback or surrender with this. So this is really, really plain vanilla. So whether this is held in a taxable account, I'm actually going to go into this now. Remember our buckets. Taxable, tax deferred, tax advantaged, or I like to call it tax-free. So taxable, anything in your taxable account, these are typically where you hold your cash, your bank accounts, your money markets, your CDs, individual stocks, individual bonds, even mutual funds. The key here is every single year you get 1099s and you pay tax. You pay tax on dividends, you pay tax on interest, you pay tax on short-term capital gains, you pay tax on long-term capital gains. Now, some people will say, and you hear it all the time, that, well, hey, if I put a $100,000 CD and I buy it with money that's in my money market account, and let's just say, banks are famous for this. When I worked at Wachovia and Wells Fargo, the bankers used to refer people to me all the time for, better earnings opportunities or better interest, and, because they would say, we have money markets at CD, but, Mark over there has, more opportunities for you to do things with your money. And that's true, or it was true. But it all depends on the structure, because if someone might say, I'm going to take the $100,000 out of this money market, and I'm going to instead put it in an annuity. And that was not something that was uncommon that I would see, because the money market, let's just say, might be paying 1%. And the person might say, well, I've got $100,000 in there. I'm not going to need for 5 years. So why not get 2.5%? Well, a couple different things you have to pay attention to. Anytime you hear the word annuity, you have to remember that interest or growth is typically tax deferred. So now it kind of bridges in between these two buckets, because tax deferred is anything that you don't pay tax on while it's growing, but you promise to pay tax later. So typically that's IRAs, 401ks, 403B plans, anything that is a retirement type of plan, and growth. So we're going to put a little star here, growth or interest, so / interest of annuities. So 2.5% on $100,000 is $2,500 for the first year. So let's say 1 year later, you're on $2,500 and you want to take that money out of that annuity. Can you do that? Well, maybe. But what will happen is you will pay ordinary income tax on that. So this is going to get a little bit in the weeds, but this is really important. So unlike a dividend or interest, potentially dividend, you'll have to pay ordinary income tax on that. The other thing is that if you are younger than 59 and a half, you may also pay a penalty, right? So just like an IRA, a 10% penalty for taking that money out. So another story, I was talking with a good friend who is an insurance broker. So in the financial world, we're really good at mixing things. This insurance agent who did auto, home, property coverage had the ability to sell annuities. And she was telling me that she just sold an annuity to a 40-year-old who was putting money away, who isn't going to need it for a few years for a home. And he put about $250,000 away. And he was going to earn X% until he needed it. So what was the, let's just say he was going to draw it out in 5 years. What's the problem with that? Well, the problem is that any interest he earns is going to be considered a penalty, right? Taking that money out prior to 59 and a half. So you really got to pay attention to that. Now, there's another thing that has to do with how annuities are taxed and that tax deferred, and they have a different kind of treatment. First of all, there's no basis. So if you own a stock and you sell it, you can either have a loss or a gain. But you really don't have a basis situation. Well, I shouldn't say that. You do have basis, but any growth that you have in that annuity is going to be come out in a last in, first out basis. So any growth that you have is going to be taxed as ordinary income, and that has to be paid first. So what I'm talking about is if you have individual stocks and you've been buying and reinvesting in stocks for many years, I can go in and I can sell different lots. I can choose which lots to sell. So you may have some at loss, some at gains, and I can really surgically go in and decide which positions to sell. Mutual funds are much different, but individual stocks and bonds you can do that with. You can't do that with an annuity because any growth is considered last in, first out, and it's taxed as ordinary income. That can be a real surprise to people at the end of the year when you get a 1099 for this gain and you think, oh my gosh, I didn't realize that I was going to have that growth. Now we're talking about $2,500. That may not be a big deal, but people put large amounts in these things because they're looking for that tax deferral, but that the piper's got to be paid at some point, right? So if you have $1 million in there, that's obviously a lot more. So now that's getting, again, a little bit in the weeds, but so that said, I am not a big fan of putting annuities in taxable accounts because they create more problems, in my opinion. One of the strategies that we have is to draw down the amount that you have in tax deferred in IRAs and tax deferred type of vehicles like annuities, because they just really compound the problem, because we've got to take that money out at some point and then you're going to pay tax on it. So we're going to come back to where those annuities should live, but I'm just going to give you a hint that it should be probably right in these two buckets. All right, so that's a fixed annuity, and I'll come back to the buckets here. Let me just pause there, see if you have any questions on fixed annuities. Okay, CD-like, pays interest, usually some kind of tie-in there, right? Where your surrender period, or you get a forfeit interest to be taken out. So very much like a CD. Then you have, and this is what most people think of when they think about annuities, you have what are called single premium immediate annuities. So this is simply, you put money in. I'm going to give you an example. We put $500,000 in, and for that $500,000, this annuity company guarantees you some level of income. So the illustration I ran for you is using Frank and Joanna Miller. So Frank and Joanna Miller you might remember the Millers. That's a sample client. We once built a financial plan together for Frank and Joanna Miller. And maybe I'll do that again at some point because that was a lot of fun. But we solved their problems. They were running out of money, and I think they're 70s after retirement. And we got them to age 95 using principal protection, using Roth conversions. I think we couldn't do life insurance for them. We just couldn't make it work, and that was unfortunate. But we used, for this example, I'm back to Frank and Joanna Miller. So what if we took $500,000 for Frank and Joanna Miller, and if we just did a single life, so just Frank's life. Frank is a few years older than Joanna, and we did this is very similar to the pension choices you might have, a single premium immediate annuity. These are also called SPIAs. You might hear this term, and that's just simply a single premium immediate annuity. So just like a pension, they're going to have choices. Okay, you give us $500,000, and ABC company will say we're going to pay you X number of dollars over your lifetime, but we're going to guarantee at least 10 years will be paid, because most people never want to take the bet that, well, hey, if Frank deposits $500,000 and he dies the next day, the insurance company gets to keep the money. Most people don't like that bet, but they might say, okay, well, if how about if it's just over my lifetime, but at least we're going to get 10 years. And I'll tell you, the annual amount that is offered in that suggestion, and that's 10-year period, certain. And I'll explain that just a little bit more. Using today's available numbers, that's $22,769.52. That's what the insurance company will guarantee that Frank receives for the rest of his life. And if he lives only 9 years, then they'll continue to pay Joanna 1 more year. If he lives only 1 year, they'll continue to pay Joanna 9 more years. If he lives 11 years and dies, they don't pay Joanna anything. But if Frank lives to be 100, they continue to pay him this $22,769 for the rest of his life. Well, back to our risks, this covers the longevity risk, right? Longevity risk. Now, someone also might say, well, Mark, it also covers market risk, right? Because you're investing $500,000, and if the market goes down, you're still going to get this $22,769. And you know what? You're right. The question is this enough for you? And is this a good plan for you? Because what most people might say is, well, if I'm married and my wife's not older than me or in bad health or something like that, we might want to do a joint life. So I looked at those numbers today too. Actually, I had Himiko from my office look at these numbers, and I think she's on the call, so I want to give her credit. So if they guaranteed this single premium immediate annuity for $500,000 for both of their lifetimes, so that's Frank and Joanna, well, then the insurance company guarantees that there will be $20,290.23 as long as one of them is alive, right? That is joint life. Well, that's probably a little bit better, but it depends on what their needs are. You know, so $20,290, I haven't done the math, but I'll just do the math for you. What it is monthly. 290, 23 divided by 12. It's $1,600, almost $1,700 a month. Now, if that's IRA money, they're going to have to pay tax on that. And if it's not IRA money, this is a difference. Now, there is a difference. I don't want to get too technical here, but there is a difference with single premium immediate annuities, and sometimes this is why they make sense. They have what's called an exclusion ratio. So they allow, remember this last in, first out that said all the taxable amount has to come out first? With single premium immediate annuities, often, and probably all the time, there's an exclusion ratio, and they may say, well, 90% of that is coming out is taxable. And this is just an example, but 10% of it is a return to premium. So it can help reduce the amount of tax if you're in a situation. But the things you want to pay attention to for single premium immediate annuities are, first of all, can you live off of this money? There typically is no cost of living adjustment, and that's with either one of these, or any opportunity for this to increase. This $20,290 is what it's going to be as long as you both are alive. So everybody's talking about inflation right now. What's the $20,290 going to be worth 10 years from now? What's going to be worth less? So does this work for you? And once you start it, you can't stop. So this is, that's typical. Typically, there's always exceptions. You cannot change it. But can this help you fund your retirement? Sure it can. If it's an IRA, here are your concerns if it's an IRA. If you have the mindset that you want to convert your money from taxable, forever taxed to never taxed, as my mentor Ed Slott said, can you convert this money? Well, not really. Yeah, I mean, you could take the distribution and convert that, but if you've got $500,000 and you have a more aggressive conversion strategy, say you want to move $100,000 a year, can you do that? You can't. You've got this lifetime income that's basically creating this, annuitized payment. This is an annuitized payment on here that's going to kind of muck up the, I said muck up, the tax effectiveness. And there is a question. Let me see who it is. Andrew asked, can this be purchased in a Roth account? Most annuities, if not all of them, can be purchased in a Roth account. So Roth IRAs are, you already pay the tax on them, and any growth is tax-free. And I'll just give away the answer now. That's where I would prefer to have annuities. Secondarily, there would be in IRAs, and they would be convertible to a Roth IRA, but we're going to spend some time on that. So back to the single premium immediate annuity. This is the traditional plan that people think of when you think about annuities. You put money in, and the insurance company guarantees what it's going to pay. These are the most simple, single, with a period certain, or joint. You can have a number of different options, a large number of different options. Just like if you get a pension, or you have a pension, you get those different payment options. So you could have, I've seen 5, 6, 7, 10 different options of how to withdraw these funds, including cash return. There's just all kinds of stuff. So that's a single premium immediate annuity. Let me just see if there's any questions before I move on from single premium immediate annuities. Okay, no questions. So on a level of popularity, I would say, these are pretty unpopular. They aren't used much. Some people will say, we're going to use this for a funding period of X number of years to help fund your early years in retirement. And there is a bucketing strategy around that, where they say we're going to do a short-term kind of income annuity to fund a period of time while we're doing Roth conversions and funding life insurance contracts. I think that can be done differently with a lot more flexibility, but there are people that think that way, and that's okay. The benefit, one of the benefits here is there are no fees. There are no fees with this. It is what it is. And again, this is typical. Are there some out there that have fees? Maybe. I haven't seen them, but there's no extra cost. It is what it is. It's dollars in, dollars out. Not much room for change, if any, along the way. So you want to stay with the idea that you cannot change. It can be held in a non-IRA, an IRA, or a Roth. So any of those buckets, any of these annuities can be held. All right, now what are popular and continue to be, and were in the past, are variable annuities. So a variable annuity works much like a mutual fund, and in fact, inside of the annuity. So think of the annuity as a shell, and then inside it, you have the ability to invest in a portfolio. So that's your typical portfolio that you see of mutual funds, and they're called subaccounts. So what often happens is that a company like BlackRock, for example, not a recommendation, just an example, will produce a carbon copy of a fund that they have, and they'll name it, ABC Fund number 2, and it'll be specific for this annuity carrier. And you can allocate a portfolio just like you would an investment portfolio. Now, the idea is, why would you do that? Well, number one, people say, well, tax deferral. You, instead of, remember that in that taxable account, instead of having $1 million here, that's always producing dividends, interest, and 1099s, well, you can grow this. And if it grows, so if you average 7% a year, this will double in 10.2 years. So in 10.2 years, this is just math, right? There's no guarantee, or I'm just giving you an example. Then now you have $2 million and you've grown $1 million of it tax deferred. You haven't paid those taxes along the way. But I have to tell you from my experiences that there's a lot of people who call me on a regular basis and say, Mark, I've been doing all these things to defer taxes all these years. And I've read Ed Slott's book now, and I've watched the videos, and I've heard you, and I've read, David McKnight's book. And now what the heck do I do with this $1 million? Because how do I get it out of there without being hammered in taxes? And I better do it soon. So be aware of that. So that's one thing that people say, tax deferred. The other things that are common with variable annuities, they don't have to, are some kind of future income. Oh, it's the end of the day and my handwriting's horrible. Future, I'll try to slow down. Future income protection. All right, just checking my time. So income. This addresses longevity risk. So this is almost a hybrid of the single premium immediate annuity, right? So what they say is you can invest this money, and at some point we're going to guarantee that funds come out of here. And then I have an illustration shows you how that can work. Not a recommendation for this company. I tried to carve it out so the company wasn't even on there. But if you see something that refers to the company, just know it's not a recommendation for you, for anybody else. It's just an example. So what they'll say is, well, if you invest this money, and regardless of what box it lives in here, which bucket, you invest this money, and at some point in the future, you can start taking income from it. Well, the income can come out generally in two ways. A guaranteed minimum income benefit, you see these as GMIBs, guaranteed minimum income benefit, or a guaranteed withdrawal benefit. So a guaranteed minimum income benefit requires what's called annuitization. And a guaranteed withdrawal benefit, no annuitization. So that demands an explanation. What is annuitization? Annuitization simply means you take what you've earned and now you turn it into kind of a SPIA, a single premium immediate annuity. In this example, we use $2 million. You've grown it to $2 million, and now you say, we're going to start taking income off of this. What happens in this example here, guaranteed minimum income benefit, that value, that $2 million goes away, and now it becomes, let's just use $100,000 a year. Now it becomes $100,000 a year for single life, maybe $95,000 a year for joint life. These are options. Maybe $98,000 a year for single with a 10-year period certain, like we showed above. So you now have all these different options to get your money back. So what's the benefit of that? Why wouldn't you just start pulling money off of that $2 million? Well, a couple things. Longevity risk, number one, and market risk. Because we know if this is a typical investment portfolio of $2 million, as you start taking $100,000 a year, unless you have growth, it's going to be reduced, right? And so now we're at $1.9 million. Next year we're at $1.8 million. And this is if there's no growth or no loss. Everybody loves the growth, but most people are concerned about the loss. So if you're drawing $100,000 a year and you need that $100,000 a year, and this $2 million suddenly drops to $1.5 million because of market activity, can that happen? Yes, of course it can happen. Well, the annuity company guarantees that you'll get that $100,000 every year for as long as you're alive, depending on your risk, right? Because you've annuitized, you've given up that money. So the risk is on the insurance company. It's on ABC Insurance Company. It's no longer on you. So what does it matter to you? Now, you also don't get any higher amount. You get $100,000 a year. That's what it is. That might be great, but in 10 years, what's that worth as far as spending power? It might be worth $80,000. Yeah, because of inflation. So now the second option is a guaranteed withdrawal benefit. Now I have to tell you, between the two, this is the one I prefer. I don't use variable annuities much anymore because of the cost, and we're going to talk about the cost, just in very certain circumstances. But the guaranteed withdrawal benefit does not require annuitization, so you keep this ownership of this portfolio, and you can start and stop those withdrawals at any time. I didn't mention that, but with guaranteed minimum income benefit, it again acts like that single premium immediate annuity where you're going to get that money whether you want it or not. With a guaranteed withdrawal benefit, well, you can choose, typically, not always, but you can choose to take it 1 year, turn it off the next year, take it for 5 more years, however you want to do it. And it does give you a level of protection here, because again, if your portfolio drops, let's say it drops in half, you started $100,000 a year on $2 million, and then suddenly it's just worth $100,000. Well, they're going to continue to pay your $100,000. And the reason we use annuities is, what if the portfolio over time goes to zero? What if this big bucket of $2 million goes to $0? Well, the insurance company, as long as you're alive, and sometimes as long as you or your spouse is alive, they continue to pay the $100,000 a year. Very, very unlikely, no matter what these companies tell you, with a guaranteed withdrawal benefit. Again, we're talking about guaranteed withdrawal benefit. It's very unlikely that you're ever going to see an increase in this on a yearly basis or at any time. They will tell you that of course, there's an opportunity for that if the market performs, and because you're still invested. If the market performs and you get over a certain threshold, well, now you could be drawing $110,000 a year, and I'll show you that as an example. But it's very, very unlikely, and I'll tell you the reasons for that. So let me pause there, see if there's any questions. Okay. I hope this is gelling together. So we had a single premium immediate annuity, and now we had first a fixed annuity, acts just like a CD. A single premium immediate annuity is very much like a pension. You put money in, you get income, and it typically cannot be changed. You get it for a certain period of time. A variable annuity has investments within it, so you have the risk of those investments, but typically there's some level of guarantee, an income benefit, a withdrawal benefit, and they give you some minimum guarantees on future income. Now, there's also, I don't want to forget about this, there's also a death benefit. I really believe there has to be a death benefit with annuities for them to be structured correctly as annuities. So there are all kinds of nuances with these withdrawal benefits, income benefits, and death benefits. Sometimes and again, I could not cover them all in an hour and a half or even probably 5 hours. But a typical death benefit works like this. I'm going to go back to the Frank and Joanna Miller example, $500,000. You put $500,000 in, they invested in a portfolio. If this portfolio does not perform, let's just say, God forbid, it drops to $300,000 and Frank dies, well, Joanna gets $500,000 back. That's not a bad deal. If it grows from $500,000 to $600,000, and God forbid, Frank dies, well, Joanna, assuming Joanna's his beneficiary, Joanna gets $600,000. Now, if it grows from $500,000 to $600,000 and Frank withdraws $100,000 in a year, what would Joanna get? Well, she'd get probably $500,000, depending on how it's structured. And then there's other nuances there. Here's an example. So if it goes from $500,000 to $300,000, and I told you Joanna gets $500,000. Well, what if before Frank died, he withdrew $100,000? Well, then Joanna would get $400,000. So there's just some buffers and protections in there. Now, annuity companies will offer you all kinds of different guarantees. They'll say on any withdrawal benefit, whether it's the GMIB, guaranteed minimum income benefit, or guaranteed withdrawal benefit, they'll say, well, you can have growth in the market, but we'll guarantee you do at least something. We're going to guarantee you earn 5% a year, and we might do that for 10 years. These used to be really robust. I still have some annuities with older clients of mine that guarantee 5% a year. I'm hoping I didn't say the company because I don't think they offer it anymore, but 5% a year until age 90. So for a death benefit. So come hell or high water, they're earning 5%. They can do better. So if they have an 8% year, that's great, but they're earning at least 5. Well, that's pretty great until age 90. If you don't need those funds and you're just trying to protect it for your heirs, that's a pretty good situation. So what they'll say is, well, for income, we're going to guarantee 5. Sometimes it's 6%, sometimes it's 7%. Often today you see simple interest, and you got to pay attention to that detail. Is my credited interest simple interest or compound? That's an important distinction. And I'll break away and explain that to you for a moment. So let's use the $500,000. And let's use 10%. Let's keep the math easy. 10% simple interest. So that means in year one, it's really the same. In year one, 10%, the credit to the portfolio is $50,000. Now, goodness gracious. This is simple interest. Simple interest. In year two, the credit to the portfolio at 10% is what? Well, some people think it's now 550,000 times 10%. That's not the case. That's compound interest. Simple interest just says we're going to credit another $50,000. Obviously, compound interest would be $55,000. So know the difference, because 10% compound is much, much greater than 10% simple. And by the way, this is just an example. Nobody out there that I know of is offering 10%, certainly not 10% compound. So pay attention to that if you're being advised to use an annuity in your retirement plan and you're getting some kind of guarantee, because there's a lot of information out there. Is it simple interest or compound interest? And listen, it's not uncommon for people to come to me and they have a lot of money in annuities. And I'm going to talk about percentages and what you should have, in my opinion, but many people have much, much more in it. And when we're trying to do Roth conversions, it makes it challenging considering the companies. There are typically ways to unwind them. So if you have a question about, you have a lot of annuities, or you have annuities you don't quite understand, please make sure to schedule some time with me and we'll take care of it. And I don't know if I mentioned this, but you'll see on my calendar that time is tight. I have some hours tomorrow that I set aside just for you folks. And then not next week, but the following week in June, and then sometime in July. If you can't find something, please reach out to us and let us know, and we'll make sure to accommodate you. Okay. So where was I with variable annuities? So death benefit, income benefit. You will see fluctuation. You will see fluctuation from time to time on your statements, because you have this portfolio. So back to Frank and Joanna Miller's 500,000. Sometimes that statement is going to say 550,000. Sometimes it could say 450,000. You've got to know what your baseline is, and if there's any guarantees, what those guarantees are. There aren't always guarantees, but at times there are. So I do have an illustration. Let me find this. So I'm going to seek out my illustrations. So here is an illustration for a variable annuity. So this is a variable annuity with an income and a death benefit. Perfect. So this is for Frank and Joanna Miller, and we're starting with a $500,000. Let's make this a different color. A $500,000 investment. And like I said, that's going to be invested in sub accounts. You're going to have fluctuation up and down. And you can see this annual return is negative 5.94, positive 19.9, 4.29, 8.57, negative 1.4. And you're going to see that fluctuation. So they put in $500,000 in that first year. They're actually negative 470,000. Now, what they'll tell you is, well, wait a minute, even though you're negative over here, you're positive here. This is your protected balance or guaranteed withdrawal balance. And they're telling you at $525,000, you can take out $15,750 a year. And the death benefit here is still 500,000. So it's a really great illustration. Just make this a little bit bigger so they can see it. This is a really great illustration showing you exactly what I said about how even though the value goes down, the death benefit. So it covers potentially income risk, longevity risk, and it covers potentially market risk because, doesn't it? Because they're giving you some guarantees here. So sorry about that. So this looks like it's a 5% guaranteed growth rate, right? So 5 to 5.25, 525,000, even in a year when there's negative returns. So let's just say in this case, they illustrated it here. In 10 years, this grows. So this contract value grows. In 10 years, it grows to $1.3 million. Well, for $1.3 million, if we track it over here, your protected guaranteed withdrawal balance is just shy of $1.3 million. You can take out now $38,991 for life. And just because I know how I requested this is for both Frank and Joanna. Well, that's not bad, right? Well, there's a couple things you've got to pay attention to. I've got the chart below, but I'm just going to tell you the fees on this are 3.69%. Variable annuities carry fees, period. There are fees in the contract. There are fees for the investments within the contract, and you better know what those fees are, because 3.69, believe it or not, is pretty darn low in the annuity world. I've seen 5, I've seen 6, and I've seen higher. So it's really hard to overcome these fees. That's one of the reasons I don't use them as much, but sometimes it makes sense. But what you'll see is you also have a death benefit for that 1,000 or that $1.3 million. So that would also go to Joanna if God forbid Frank died. But these funds here, this 38,991, while that's a great guarantee, and even if the account value goes to 0, they continue to pay that 38,991 forever. But that is very, 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 very unlikely to ever increase. So that kind of affects the longevity risk, doesn't it? While it's a help to the longevity risk, 38,991, at some point, because of inflation, that's going to be diminished. So that is variable annuities and using a guaranteed withdrawal benefit. And where I believe these should rest, if I go back to the buckets, taxable, tax deferred, and tax advantaged or tax free, these should live right in this bucket or in this bucket. Now, here's a caveat. You have to be careful, and this depends on the company you're dealing with. Not every company will allow you to properly, in my opinion, convert from a traditional IRA to a Roth IRA, because what happens, we know how important it is to get money from this tax deferred bucket to the tax advantage bucket. And most of you are either planning to or thinking about it, or if you're working with us, we're getting it done, convert from traditional IRA to Roth IRA, Roth conversions, over a period of time. So now let's say here we are. This is where we are right now this year. Let's say Frank and Joanna did this 10 years ago. You've grown it to $1.3 million. This $1.3 million lives right here. If, in fact, the contract value of the $1.3 million is in there, you could convert that piecemeal over time, because nobody wants to convert $1.3 million in 1 year. You might want to do $130,000 over 10 years or some combination. But if, in fact, the income benefit is higher than the value, right? Remember this 38,000? Is that what the number was? 38? Yeah, 38,000 called $39,000. Once you convert it, those guarantees go away. So those guarantees you paid for all those years at 3.69%, with most companies, once you start converting money, at least for that portion of the 130,000, they no longer guarantee income on that. So while it can stay in the contract, it's not going to have, you're not going to have 10%, right? This is 10% of $1.3 million. You're not going to have 10% of that 39,000 to live off of. It won't be in a Roth. It'll have to come from traditional. So you give up the ability to have that guarantee. There are only 2 companies that I know of that allow for all those guarantees to pass from the traditional IRA to the Roth IRA. I'm not going to name names tonight because I'm worried about what regulators might say about that. But if you contact me, I can talk more about that. But that's a variable annuity. Pay attention to the potential for loss here, right? You see negative 21%. Look at that. Negative 40%. That is not principal protection, friends. Negative 1.5%, and we got to pay attention to the fees. Makes sense sometimes, but you've got to pay attention to these details. All right, let me pause there. No questions. You guys are all hanging with me. That's great. This is complex stuff, and I hope I'm doing a good job of making it understandable. Okay, so they're variable annuities. So variable annuities get really confusing because there's so many different moving parts. They have subaccounts, investments within that. Remember that. Just remember that that pie chart. So they're your subaccounts. Can go up, can go down. They are typically not convertible to Roth IRAs to keep their guarantees if they have guarantees. The costs are higher. Again, they can go up, can go down, but they can have income guarantees and they can have very good death benefit guarantees. Compared to the fixed annuity or the SPIA, or what I'm going to talk about next, which is the fixed indexed annuity, you have an opportunity, more of an opportunity for growth, but you've got these other risks. You can also lose money, so you've got to be careful about that. There is no true principal protection that I've ever seen with a variable annuity. Okay, so now let's go to the next one on my list, which are fixed indexed annuities. Fixed indexed annuities. All right, now these are, and we're getting there. They're very complex, folks, and there's a lot to talk about. These are, I would think of it as kind of a hybrid. So these are tied to an index. So let's just simply use the S&P 500, although I do have an illustration and that's not what I'm using. Generally, a fixed index annuity will say, we're going to give you a certain percentage of growth of an index. So using the S&P 500. So the S&P 500 is up about 30% from last year. So from this is not exact. This is just what my memory is telling me, but I think it's pretty close. So from 6/9/2020 to 6/9/2021, that's probably about the return of the S&P 500. So now, if you were invested in a fixed indexed annuity, and you might have a cap, so you might say that, well, this is great. I'm going to get a 30% return. Well, the fixed index annuity might say, well, wait a minute, no. We're only going to give you 5% of that. Or they might say, we're going to give you 90% of, not 5% of 30, but we're going to give you 5% return. That's a cap. You might also have a participation rate. And they might say, we're going to give you 90% of the growth of the S&P 500, or let's make it simple and say, we're going to give you 50%. So you might get a return of 15% on that. Well, you might say to me now, well, Mark, why would I do that over a variable annuity? Because even though I can lose money, I can also have gains. Well, with fixed index annuities, there is no loss, right? You have a floor. You can never go below 0. So most people find this compelling because it is true principal protection. Where a variable annuity doesn't really have true principal protection. It can have those future income protections, but not true principal protection. Because remember back here, let's pull this up, where we had a negative 21% return and a negative 40% return, with a fixed index annuity, they would equal 0. They would equal 0 return. Well, that is really valuable. And I would say that might be just as valuable as these big returns, especially if you're using a participation rate or a generous cap. Because if you think about this, if the normal progress of your investments is something like this, if you never experience this trough here, if you never have this, if you're wiping out this, and we did this in our financial plan, Frank and Joanna Miller, we had the first thing we did is we took out negative years, because what really killed them was sequence of return. Sequence of return risk is when the market started falling, your investments start falling when you're taking money out. Many of you are in that situation now. There's tons, millions and millions of baby boomers who are now retiring. You've been saving money in 401ks, IRAs, the way everybody told you to for many, many years. You've saved a bunch of money. Now you have to start withdrawing it. But my gosh, what's going on in the markets? Well, if you're withdrawing money and your funds are falling at the same time, that is a really bad recipe for disaster. So if you're able to wipe out these negatives, even if you just have modest returns. So let's say here we start with, a 3% return here. And then the market, right? So you get the S&P 500 does 3%, you get 100% of that, but then the next year it's down 10. Well, if you never experience the 10, and then your second year here, this is year 2, you're at 0. So you've never had to dig out of that hole. You're still positive 3%, right? So that would be on $500,000, what, 15,000. You've never given that 15,000 back, so you're at 0. Now, how about the next year? Well, if you do 3%, now you can do better than 3, but I'm just using 3 as an example. The next year you do 3% again. Well, hey, listen, if the S&P 500 did 3% from the bottom here, you're not even close. You're still climbing out of your hole. Where if you have a guarantee of no less than 0, you're never digging out of that hole. So everything is positive. So for many people, it's better to have the line just, even if it's a lighter slope, to be a gradual increase rather than the hills and valleys. So even with you, where you might end up with a better place in the end, if you're not taking withdrawals, there's a lot of value to protecting that, especially with withdrawals. Now let's talk about withdrawals. And we're really getting into principal protection, but that's where fixed index annuities really shine. Think about this. If we're down negative 10% and you have to take money out. So let's use Frank and Joanna Miller's $500,000. We're down 10%. Well, that's negative $50,000. What if they have to spend $50,000? They have to take out an additional $50,000. Well, now they're down $100,000. This $50,000 here never gets a chance to recover, does it? It doesn't. So that is what we call a drawdown effect. And we know that you have to actually return much better than 10%. If Walter's in the call, he'll give us our number. But I think it's about 14.5% just to get back to even. So that can be a long stretch there. So that compounding effect of the potential for loss and the money coming out is what can be devastating for retirements. So why not just give a floor, in my opinion? So you give a floor, so you're protecting some level of principal. Now, fixing index annuities, they have the same structure as other annuities. You got to be careful where you put them. They have that last in, first out structure. I believe they live also best. We've got, let me draw your buckets again. You've got taxable, tax deferred, and tax free, or tax advantaged, whatever you want to call that. They live best in these 2 categories. And best, or these 2 buckets, best is a company that allows you to piecemeal, like I was talking about before, over time. If you have $1 million sitting over here in your IRA, and let's just say you have $500,000 of it in an annuity, and that might be too much, then you can transfer via Roth conversion a portion every year over time. That there are, again, only 2 companies that I know that allow that. If there's any kind of guarantees on the annuities, if it's just a basic principal protection annuity, it's really easy to do. Most companies will allow it, but you've got to know the nuances of these things, and that's why it's really hard to do these things on your own. Okay, so that's fixed indexed annuities. Okay, so now that you have a general understanding of annuities, well, actually, let me share an illustration for you while I have it for a fixed indexed annuity as I did with the variable. So you should have something that shows, again, not a recommendation for this company. This is a company, you can see it up there called Allianz, but this just shows a really good example of how a fixed indexed annuity works, just a simple guaranteed principal protection. So in this case, you put $500,000 in. You'll see the credited interest. So this is historical interest going back 10 years, and then they repeat it again, right? So there's a little difference. You'll see it's 10.29 here, 2.33. I said 10.29. That's not what I meant. I meant to say 2.29 and 2.33. What you don't see here are any negatives. So now it's a laddering strategy we use now with this platform, but it used to be that we would see zeros, which was helpful from a illustration point of view. But now we see much less zeros, and that's a positive, but it isn't great from an illustration. But these are pretty modest returns. These are really good bond alternatives. So if people are putting money into bonds to offset the risk of stock, bonds have their own separate risks with interest rates. And so you can get bond-like returns. These big numbers here, 8.39, that's kind of an outlier. But if you're looking at 5.5, 6, they're kind of big too. Fives and fours, they're good, decent returns for something that has zero risk. So the risk, market risk is not there at all. So if there was a negative return, so if we went and the S&P 500 or the investments we saw in the variable annuity, remember that third negative 30% return we saw? Well, if that was in this year, what you would have is a zero. But that's not the case here. In this case, let me clear this mess. In this case, we start with $500,000. Let's say 10 years later, oh, I have to talk about surrender charges for variable annuities, fixed indexed annuities, particularly. And 10 years later, we've grown that to $780,000 or $762,000. At that point, you could just say, okay, I'm really happy with that growth. Things have changed. Whatever the situation may be, I'm really comfortable with how things are in the markets. You can keep your money in there if you want, or you can continue or with something else, but it continues to grow. So in this case, you own it for 30 years, it grows to $1.7 million, and you haven't experienced any risk. Now, there are other fixed indexed annuities. I'm looking at the clock. I don't want to get into the product too much, but there are others with those income benefits, like the variable annuities. They have the principal protection, but they also have income benefits. This fixed index annuity that I'm showing you here is zero fee. That's good too. Some of them have either a fee built in if they have income benefits, or the potential for a fee. So you want to pay attention to those things. But this is one company in particular that I have, since I have it up. Uh-oh, where'd that go? How'd that happen? Oh boy, let me pause this. See how that just jumped? All right, this video is not going on the website. Okay. This company here, Allianz, is one that allows for internal Roth conversion. So whether it's just principal guarantee or if you have some kind of income guarantee, it allows for internal Roth conversions, which is a benefit when you're talking about IRAs. Now, there are surrender charges. So let's talk about surrender charges. And I'm going to give you an example. What is a surrender charge? I told you this is a word that you're going to need to know. A surrender charge is, these guarantees associated with these companies rely on them knowing what funds they're going to have. And they have to report to the regulators every year in each state where they do business, how much funds they have and how much they have in liabilities. So they may say from anywhere from, it can be a 5-year period to a 10-year period to even more, right? I've seen 20. Be careful about that. What's common is 5 to 10 years. They say that we're going to, if you take your money out early, we're going to charge you, right? So it can be, first year can be 10%. This is an example. Then it goes down to 9, 8, 7, 6, etc. So actually, I'll show you on this. This is a 10-year surrender. Let me erase these circles. And this is important to know with your annuities. So you'll see here, there's an accumulation value and there's a cash value. There's a difference in the first few years. So you get these credits here, 5.4%, 5.8%, but let's just say you wanted to take money out. It's pretty close though. You wanted to take money out in year 4. Well, the cash value is $592,000, but what you would take home is $560,000. So if it's an IRA, that's of course pre-tax, but the break even is pretty close. If you're worried about putting money aside, $500,000, and you say, well, geez, I do want to protect this, but what if I need it? You know, with some modest returns here, 2.3% and 4.53%, you're pretty much even after year 2. In this example, it's going to be different for every person's experience because, you know, they base these things on when they're issued. So the calculations are done year over year. Fixed indexed annuities are calculated once a year, and you have your own anniversary date. Today's the 9th of June. That might be the start for you. And then you get a valuation at the end of the year next year. But you've got to pay attention to the surrenders. Now, that's going to be much different with a variable annuity because you have the risk of the market being down. And if you want to surrender that policy, you not only pay, you're going to suffer the losses, but you're going to pay that surrender charge on top of it. What happens if you need money along the way? Like I said, you can bail out here and you get a little bit more than what you wanted or what you started with. Your break even is going to be 10 years. So this is where the accumulation value and the cash value is the same. If you need money along the way, you can take 10% of what you put in. Typically, some companies are 5, but most of them are 10. So you take $50,000 a year with no penalty. So there are some fail safes in there. So why would you take money early? Well, there's that catastrophic thing. Something happens that you weren't planning on. But what if the markets are down significantly? You know, I had conversations this time last year with folks saying, well, if we really need to, we could draw money out of the annuity. And they said, why would we do that? Well, these can be really good if we wait a while, if they have income benefits. But if your other investments are down, and they were down significantly last year, if your other investments are down and this investment can't go below 0, if you need 50,000, why wouldn't you take it out of this? Because again, going back to that beautiful mountain chart I did, you're never, remember this one that got huge? It looks like pizza slice. You're never climbing, goodness gracious. You're never climbing out of this hole here. So if you need $50,000, why not take it from something that's principal protected? So it could be, you want many levers to pull from. And this goes back to that funding of retirement. You want many levers to pull from. And you got to make sure that they're structured in the right buckets. Remember, there's a mathematically ideal amount to have in each bucket. So let's jump into that. Let's talk about that. I think you have a basic understanding. After nearly an hour and a half now, we've run through the basics of annuities. And I know it's a lot. Now let's talk about funding. It's really sometimes challenging to determine how much we should put into annuities, because if you have $2 million in your investments, so here's your investments. You've got to balance liquidity, money that you need now, and money that you're going to need later. And then almost everybody's worried about market, right? Market risk. Remember, that's a big one, market risk or market risk. Put that here. Almost everybody's worried about that. So the smart thing to do is think of your investments as a whole. I'm not even going to get into account segmentation. That's a whole other discussion. But when we're talking about principal protection, there's some kind of protection of income, some kind of protection of death benefit if you're going a variable annuity route. And fixed index annuities have death benefit guarantees also. I don't want to just put that on variable annuities. They have death benefit guarantees also. You want to figure out how much you want to have at risk and how much you want to have protected. I will go as far as a recommendation up to half considering this situation. For most people, the math works really well if we go to a third. So, so what would that be for 2 million. I should have this math done. I do this all the time. Divided by 3. That's $666,000. I'm going to say $650,000. So if you take $650,000 and you put this into principal protected, I believe I'm a bigger fan of the fixed index annuities. Going to be honest with you, because of the low or no fees, and the true principal protection. So you're climbing out of that hole. Then when the markets drop, this money is protected. It's not going to go below zero. And I've seen it in folks' eyes when they look at their performance reports and they say, wow, I feel much better. That was a common phrase last year when I was going over portfolios reviews with people when we were in the middle of the COVID drop. I thought it was going to be much worse than that. Some people were positive during that time. You still have this portfolio at risk, right? This is going to be invested in some way. And if you're working with me, this is going to be segmented, right? Account segmentation, where we have, different accounts for each stage of your life instead of just one big allocation. But this, you got to figure out how much you want to set aside for protection. Now, remember, can't go below zero, can do count on 4, 5, 6, maybe 3, 4, 5, 6%. Don't count on the big returns, but you're not necessarily looking for the big returns here. You're looking for protection of your money, whether it's in the short term or in the long term. These are better if you let them run for a while, but if you need access early on, sometimes it makes sense to draw them if the market's down. Again, if you've got a portfolio, if you're doing it a very traditional way and you're principal protected for 650, and this is a growth or a moderate growth portfolio, and during a normal downturn, it's down 10%. So you've got $1.35 million that's now down $135,000, and you say, I need $50,000 for something. Do you want to take it from this portfolio that's already down, or do you want to take it from this portfolio over here that has principal protection? Well, I might say to you, let's take that $50,000 out of here and let this have an opportunity to grow. Now, if you're working with me, you would have that covered, right, in one of these two segments. But again, that's a big discussion. So that's general funding and how you come up with how much it should be for funding of your retirement. Now, let's get a little more detailed. Remember our buckets. I've only drawn these about 10 times now. Tax tonight. Taxable, 2 different A's. Taxable, tax deferred, and tax advantage or tax free. So we talked about this. These are our 1099 friends, right? And they send out tax every single year, or we have to pay tax on every single year. These are your IRAs, etc., that we're going to pay tax on later. And we know that taxes have to double in the next 10 years. We all know this for all the various reasons that I can't go into with the time allotted right now. We want these annuities, in my opinion, to live, as I said, in these boxes. This tax advantage is anything Roth and properly structured cash value life insurance. So we're not putting annuities in life insurance. It's a totally different bucket, totally different vehicle. So I'm not even going to touch on that. Very, very valuable if you can get it. But we're talking about annuities. So if we could go back in time and fund all of your IRAs in Roth, well, most of you would probably do it. Some of you can keep a small amount, and it's different for everybody in your Roth IRA. So you might be able to keep, $100,000 to $300,000 in your tax deferred, traditional IRA, and still pay no tax on that. Some people have to take that all the way down to zero. But if we could go back in time and fund the Roth IRA 100%, most of us would, or at least the majority. Put the majority of money in here. So if you're going to protect your money, you want to protect it here. And if you want to grow your money, you want to grow it here. Because anything that comes out of here, go back to that $35,000 that was guaranteed to come out of the variable annuity contract. Would you rather that $35,000 come from this bucket or this bucket? Well, of course you'd want it to come out of this bucket, right? Because the tax has already been paid. So anything coming out of here, this bucket is 0% tax. This is going to be the big, I don't know tax rate. And in my studies and some of my colleagues in the Slott Master Lead Advisor Group, we feel that taxes are going to be the 40 to 45% effective rate within 10 years for the average middle class American. So would you rather pay tax now doing these conversions or pay tax later when we just don't know what it's going to be? So funding of your retirement is vitally important. Having the right amount of money in each one of these buckets is vitally important. Using the right vehicles is vitally important. Having a strong asset allocation strategy, principal protection, and account segmentation is how we handle funding, tax efficiency. It's just checking off each one of these. Market risk. Let's go through them. Principal protection, asset allocation, account segmentation. That's how we handle market risk, right? So the asset allocation tells us we put together a portfolio that that is the right amount of risk for the right amount of return that we're looking for, and make sure the components are strong and evaluate those on a regular basis and adjust as needed. That's basic asset allocation. Depends on what kind of theory you fall into. I believe in strategic asset allocation. I'm happy to talk more about that. Principal protection. How much of that total pie, $2 million, do you want protected? You know, usually you start at a third. I would be really pressed to go more than a half for folks, but it all depends. That handles market risk. How about longevity risk? Well, if you have a good handle on your, and this is part of financial planning too, if you have a good handle on your expenses and your income and how things flow, you're going to be able to identify the issues before they become issues, the potential issues before they become issues. So can principal protection help with longevity risk? Well, of course, because it's going to stop you from drawing out funds when the markets are down, because most people just invest a certain way, right? They do one of those risk scores and they'll say, okay, I'm moderate growth, or I'm moderate and this is how I should be invested. And when the markets go up or down, you're going to be drawing out money no matter what. That is a bad plan, in my opinion. So for principal protection, if you carve out, a third of that, in this example is $650,000, the one I showed you, remember that? Sure, that's going to help with that because you're never drawing out of that. Of course, asset allocation, making sure you've got the right components, and account segmentation will help with longevity risk as well, because you're funding what you need in the beginning, you're letting the others grow, and then you can conveyor belt that down. How about tax rate risk? Well, principal protection isn't really going to help with tax rate risk, but the right type of annuity, if you're using principal protection, will help with tax rate risk. So you want an annuity that's going to be able to convert. You want to be able to convert that IRA to a Roth IRA. And if you have benefits in those annuity, income benefits, death benefit, that doesn't get deteriorated or vanished. So a company, a company I respect, you might have that an annuity with that company, and you'll call them and you'll say, can I convert my annuity, my IRA annuity, to a Roth IRA? And they'll say yes. And then you might call me back and I would say to you, well, did you ask the next question? And you'll say, oh, I forgot. What was the next question? Well, the next question is, you have $100,000. This is an example. You have $100,000 of guarantees for your income and death benefit. What happens to those guarantees when you convert? So you go back and you call the annuity company and they say, oh, well, I lose those guarantees or a portion of them. Well, that's not a good answer. So principal protection alone isn't going to get you the tax rate risk, manage tax rate risk, but having the right vehicles to be able to convert those funds is going to help you manage that tax rate risk. Will asset allocation help you? No. Will account segmentation help you? Absolutely. So account segmentation and a good tax plan. Account segmentation is going to help you because you have the money set aside in appropriate branches or tranches, if we want to get fancy, to fund the conversions that you need to do. And you have got a well thought out and illustrated plan. Now, what about long-term care risk? We haven't spent a lot of time talking about that tonight. But can these help with that? Well, you're darn right. So if you manage your tax rate risk, you're going to have more spendable cash money that you won't have to give to the IRS. Now, people might say, well, I've got a pretty generous amount that I can pull out tax-free. You know, if I've got long-term care insurance, something like that, and that's great. You should have all those things, because if you need long-term care, you're going to have lots of vehicles to pull from, and you should have as many as you can. A good life insurance company will have a long-term care, some kind of long-term care component, either, you know, traditional long-term care rider, a chronic illness rider, or critical illness rider. So, you know, if you've got that type of life insurance policy, that's good. If you have a long-term care, traditional long-term care contract, that might be good as well. Some of these annuities have, for instance, the one I showed you, I'm sorry, not the one I showed you, but the other one that kind of is a beefed up version of the fixed indexed annuity I showed you, has a benefit that'll pay income, increased income for long-term care. So that's helpful as well. So that'll help. And asset allocation, account segmentation will certainly help with that. This funding is very, very important, because, you know, when we do the segmentation, we end up with, you know, these different buckets of money, and it kind of looks like this, different style, right? And we identify, you might need $300,000 for your first 5 years, or let's use 3 years. And then your second 3 years, let's just say you need $250,000. And then your third 3 years, 789, you need $300,000 again for some reason. And then you've got longevity funds, longevity and legacy. So we might have $1 million sitting over here that you may never use. That is for longevity and legacy. That is your extra long-term care money. That is your extra, I just want to do stuff money. That is legacy money that you may pass to your kids. That is, again, we identify through the account segmentation the money we're never going to use, potentially. You may need it, you may want it, but from the information we have, it's likely or possible you'll never use it. So with the account segmentation, here I go, I'm getting into it. Remember that this segment here that you're going to be using right away, you invest more conservatively. So maybe you're getting a 2% return, but very, very little volatility. The segment here, you know, maybe you're getting a 4% return, a little bit more volatility. Here, you might be getting more, 5 to 6% return, a little bit more volatility, but here we can shoot for the higher returns, right? 8, 9% plus, because you're not going to be using that money, and it can expand. We have some clients with 5, 6, 7 segments. So funding is very important. So I think we've covered all of these. I think we've shown that it's very important where these assets sit and how they're covered, and the flexibility that they have. Flexibility is really important. I did my best to give you a baseline of annuities. I know that took a long time, but they're very complex. And when I tell you we've only scratched the surface, we have only scratched the surface. I do have a question, so I'm going to see what question that is. It's 808, so we're a little bit over. Roseanne asks, do you have to purchase riders on an insurance policy when you take out the policy, or can you add one later? Well, that depends on that coverage. So with annuities in particular, most annuity companies, you have to decide how you want your future income to come out when you purchase the contract. With some, you have options down the road. With life insurance policies, you typically have to purchase the rider, if you have a rider, before or at issue, and you've got to qualify for it. So that's very, very important. Good question, Roseanne. And I know there's a lot of depends answers to my question, but it depends. I don't see any other questions. Any other questions from anybody? All right, so this is complex stuff. I know it was complex, but I hope it was helpful. Again, we just barely scratched the surface. My goal was to give you a more in-depth. We talked about annuities and funding for a little bit more than an hour and a half here, rather than the 15 minutes we did on Tuesday. So I hope you understand it a little bit more. If you want to talk more about it, you can schedule a time. We can certainly do that. If you have existing annuities and you don't understand what you have, schedule a time. I'm happy to go through them with you, go through the pros and cons. We have an annuity intelligence report that we can run that's like a morning star for annuities that helps us identify the good things and the bad things, if there's any bad things or if there's any good things. But it's important to understand what you have and how it fits into your plan and how it fits in to your flow, right? And your funding, because you don't want any surprises. And these are things you should review every year. I think you folks have heard me many times. We review our annuity contracts every single year. Beneficiary designations, very important. The guarantees that are associated with them, very important to review every year because they're all different. And it's good for you to review because it brings you back. I've got one client who now is drawing off of his annuities that he purchased, well, more than 10 years ago, because he waited 10 years, maybe 11 years. And he's very thankful. But every year he would say, just remind me how these things work again. And we would go through it. I went through it with him and his son. And again, he's kind of enjoying the fruits of what happened at the time. He invested at a really difficult time, right at the end of 2007, October 2007, right before the big crash, the Great Recession. So it really saved his skin, and he's very thankful. But folks, that's what we have for tonight. I look forward to seeing you in the upcoming. Let me pause my share here so I can just read those dates to you again. And I appreciate your patience with me moving through the whiteboard and finding things and all that. But upcoming, so June 30th, we have fiduciary assistance for powers of attorney, trustees, and executors. July 21st, we have our investment fundamentals. And then July 28th, we have the reality of the 4% rule. So if I don't talk to you before Tuesday, we'll see you on Tuesday at 10 a.m. Hopefully this recording will get out there rather quickly. I do have a really great, bright young man helping me with my recordings, and he had to catch up. We had, I think I shared with you, 85 or 90 recordings since last year. So he's been working his butt off on it. But now it's in compliance, right? So these things have to get reviewed, and that's a real pain. But I hope that was helpful. I'm going to stop talking now. It's 8:11. I hope everyone has a great night, and we'll see you soon. Take care.
Hello again. I hope you enjoyed the video and perhaps you learned something new that can help you. If you want to schedule time for me for a no cost, no obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.